Hi, this is a corporate level strategy analysis about General Electric, presented by me, Raymond Cato. First, let's talk about the company background and history, GE. GE is a very large company, conglomerate. It's headquartered in Boston, Massachusetts, founded in 1892 by Thomas Edison, J.P. Morgan, and Charles Kaufman. They combined two companies together and formed GE. So it's over 100 years old. It's ranked as one of the largest firms in the US and one of the largest conglomerates in the world by market cap. And currently it has about 8 primary subsidiaries, many divisions, subdivisions. They are producing all kinds of, uh, you know, high tech or products like aircraft engines, water processing equipment, uh, consumer appliances, industrial products, etc. And currently they're in over 100 over 100 countries all over the world, and they employ over 168,000 people worldwide. So they're a very large company. So this is a snapshot of GE subsidiaries. As you can see, they're in everything. They have, into aerospace. They have a GE Capital, which provides financing. GE Digital, healthcare, power, renewable energy. They have research. They actually outsource their research to other companies. They're into 3D printing. So it gives you an idea of what kind of subsidiaries they have. Quite a few. So let's talk about GE's diversification strategy. We identified GE's diversification strategy as a related linked diversification strategy. So what does that mean? That means that levels of diversification. They have less than 70% of their revenue comes from any dominant business. They're well diversified, spread out. They're involved in commonly related businesses. So the company is creating or investing mostly in businesses that are related to its core strategy, which is technology or technology related services. Also, there's strong connections between divisions. So GE does promote sharing of technology and product sharing and shared distribution channels. So there's strong connections between their divisions. So that's why it was classified as a related linked diversification strategy. GE's organizational structure. So if you look to the right, we can see that we have a kind of a diagram, what have you, of a related constrained strategy organizational structure. So GE is very very similar to the one to the right, in that you have this top, headquarters at the top, and at the bottom they have these divisions which are linked together pretty closely. But if you look to the left, this is what they're following this model from 2012, and they call their structure a flat structure. Probably it's very similar, but they since they have so many divisions, so many subdivisions, they keep a let's go to the next slide. They keep a small staff, a relatively small staff at headquarters. Um, this structure was first promoted by their former CEO Jack Welch, and they still pretty much follow it. So it's designed to create tight links between subsidiaries and divisions within them, like a constrained structure. Um, Corporate headquarters is at the top, and the eight subsidiaries are headed by many of them have their own presidents and vice presidents. Several of them sit on the board, and at corporate headquarters they have a relatively small corporate staff to manage some of the support activities. So they're small at the top and pretty large at the bottom. So the question is the structure that GE has consistent with its diversification strategy? Is that is it consistent? And yes, it is pretty consistent with this strategy they're using. So the structure and the strategy are consistent, and what it and it allows three key benefits: cooperative sharing and innovation culture, which promotes their desire to innovate and create new technology. So a lot of employees work together, even across divisions, across subsidiaries. They work on the same projects. Economy of scope. The company is able to create cost savings as a result of transferring some of its capabilities and competencies across businesses within the organization. And efficient use of support and primary chain activities is so this strategy works very well. It's very consistent for their particular company. So let's look at the financial, do a quick financial analysis. It's going to focus on really the kind of the pain points that they might have. Looking at their finances, liquidity. We look at their liquidity ratio. We see that GE's current ratio is 1.28, so it's a little bit lower than industry average, but not too bad. Their their quick ratio is 0.93, a little bit lower, a little higher than the industry average. However, they want to, even though the industry may be also dealing with trying to pay short-term obligations. So it's something that it's not really, even though they're better than the industry, they may want to kind of try to improve that closer to bring that up a little bit. When we look at the leverage ratio, debt to asset, and debt to equity ratios, they are actually better than industry on both. So they have improved on their 3 to 5 year averages on both, particularly the debt to equity. So that tells us that they are managing their long-term debt obligations well and not overly leveraging assets or equities to support business operations. When we look at the profitability ratio, there is the gross profit margins are pretty consistent with industry. It's 24.19%. When we go down to the operating profit margin, we see that they're having some, they have the industry benchmarks 11.63. They're around 8%, a little bit more than 8%. So that tells us that there's some inefficiencies in there compared to the rest of the industry. When we look at the net profit margin, that's we're most concerned because it's in the negative 9.17% as opposed to industry benchmarks of 9.6%. And we see over the 3 to 5 year period, they actually got, they decreased their, it's gotten less profitable. So that's it's decreased even more. So that's a concern. Going down to the activity ratios, inventory turnover is 3.98. The benchmark 6.12. So they're not turning over inventory as quickly as the rest of the industry. Same thing with receivable turnover. Their industry is 13.78. So that means that on average 13.78 days. So they're not they're not processing receivables or collecting on receivables as well as the rest of the industry. So there's some inefficiencies in those operations as well. So what are our recommendations? So we have really 3 recommendations. GE should, in order to improve, obviously maybe their diversification is producing some diseconomies of scale at this point. So recommendation number 1 is to get smaller and less diversified. GE should consider the fact that they may be too big and now are experiencing some diseconomies of scale as a result. So I recommend that they consolidate their business into no more than 5 key subsidiaries. The company should divest and focus on no more than five of its most profitable businesses, and use GE capital to grow businesses, not run them. So they can invest in businesses and use some of their finance, part of their finance operations to invest in businesses, in other businesses, in technology, but not run those businesses. So that concludes my presentation, and thank you for your time.